Last week was a very difficult week, highly volatile across most asset classes. I would argue that this seeming reprieve probably will improve sentiment a bit, and probably we were due for a bounce in risk assets in any case after the performance of last week. However, I would argue that on a medium-term basis, that uncertainty is still incredibly high. You don't get a sense that, policy coming out of the U.S. today has been all that well thought through. It seems somewhat ad hoc. And these policies that they are, changing have massive implications for companies around the world. So I think that uncertainty is probably going to remain. We may see a short-term reprieve early this week. We seem to be seeing a bit of that this morning. But my sense is it's probably not going to last.
Okay. In terms of what that means in markets, massive volatility across so many asset classes, but the Treasury market this morning getting a little bit of a relief. How profound, though, is the change in terms of investor appetite towards Treasury? Should we just start there? The most important market in the world. If you're saying that White House policy is sort of ill thought out or not well thought out, that is a huge statement.
Absolutely, and I think you've hit the nail on the head. The Treasury market is the critical place to be focusing, and there are multiple factors driving the U.S. bond market, the U.S. government bond market today, and it's hard to know on any one day what's truly driving it. But I would argue that there's some structural issues that markets, for good reason, are concerned about. So we know that over the past few years, the U.S. has been running very large fiscal deficits and has been running its government debt levels to very high levels relative to history. Basically, we're back at World War II kind of levels in terms of debt to GDP. And I think what markets are worried about, and for good reason, is that if Trump's tariff policies lead to a recession or even just a sharp slowdown in U.S. economic growth. Normally, when you have a recession or slowdown in growth, you see fiscal deficits widen because you see tax revenues fall and payments for unemployment and other programs kick in. So that would mean an even larger potential supply of Treasury bonds coming into the marketplace. Supply and demand would tell you yield should rise.
How much credence should we give to foreign investors fleeing the Treasury market, given the signals that were, kind of went in a few directions last week, and there's several factors to consider when thinking about who wants Treasuries now?
Yeah, again, great question. I don't think anybody knows just yet. We're still waiting to see data. My instinct would be that probably the Chinese are reducing their holdings of U.S. Treasuries. I mean, I think a lot of countries are diversifying away from Treasuries. Obviously, Treasuries will always remain a critical part of any portfolio of any central bank. But just statements, just hints that they may not be buying as much, given the amount of uncertainty in the market about the growth outlook, about the inflation outlook. It doesn't take much to get yields moving with just a few statements.
Well, I mean, you say obviously that Treasuries form the basis of central bank and investors' portfolios, but it seems less obvious this week than it did a few weeks ago. In terms of the central bank response, Singapore eased today, got the ECB meeting this week. What do you think is going to be the central bank approach? We've had a few comments from Fed officials, but Jerome Powell speaks later this week.
Yeah, I think everyone's going to be very much focused on the Fed. I think the question really, and obviously every FOMC member will have a different view to some degree, but I think what people are trying to focus on is we know that inflation expectations, according to the Michigan survey and others, have been rising really quickly, sort of at historic pace over the past month or two. And the question is the Fed going to focus on that and hold steady and hint that it's just going to hold steady through this? Or are they going to highlight concerns about growth and the potential impact that tariffs might have on economic growth, and therefore sort of hint that possibly they'll cut? My instinct is they're going to focus on the inflation expectations. We're now, I think the U.S. swap markets are now pricing in, I think, 75 to 100 basis points of cuts over the next, by the end of the year. My sense is maybe that will be ratcheted back at some point.
A word too on Europe. You're not overly worried about the impact on the European economy in terms of the numbers that you're seeing. There's limited impact on GDP. Why, I suppose, where should we be seeing the pain, or how bad should we expect it to get?
Well, I think actually the biggest pain is going to be felt in the U.S. I think U.S. consumers and companies are going to see a hit. So consumers will see prices rise, and companies, to the extent they can't pass fully on the price increases, will see a squeeze in margin. So I think the U.S. gets hit the worst, which is why we're seeing the kind of performance of U.S. assets that we've been seeing, and I think it's rational. In terms of Europe, you're looking at around 3% of GDP exported to the U.S. So, and about 85% of the European economy is services, which are not at least directly affected by this. So obviously the impact will be very big for certain companies and certain sectors like autos. But I think a lot of the economy will be relatively immune. And then on top of that, which I'm sure you've spoken about a lot on your show, is, of course, we've seen this watershed moment, this watershed change in European fiscal policy, first from Germany, but also more broadly across Europe. And while it may take some time for that to feed through to economic growth, I think what will probably happen is that European growth will get a boost from this. So I think this shift away from the dollar is actually quite rational.